My neighbor Derek refinanced his house in 2019, 30-year fixed, $280,000 loan, 4.1% rate. He was proud of that rate, told me about it at a barbecue, like he'd won something. 3 weeks later, I refinanced the same amount, same term, same lender. My rate was 3.2%. Same neighborhood, same income bracket, actually lower than Derek's that year. The difference? By the time I sat down with that loan officer, I knew exactly one thing Derek didn't. That gap cost him an extra $43,000 over the life of his loan. He's still paying it every single month. Most people who figure this out don't come from finance. They come from the moment they realized the system wasn't going to explain itself to them. I learned that the hard way, sitting across from a loan officer, signing paperwork I didn't fully understand, smiling like I had it together. I spent years learning what that signature actually cost me. The rules aren't complicated, but nobody hands them to you. That's what this channel is here for. Not because the system is rigged exactly, but because it has layers. Most people only ever see the surface. If you've ever felt like you're doing everything right with your mortgage and still bleeding money you can't explain, drop a key in the comments. You're exactly where you need to be. Here's the real problem. The average American homeowner with a 30-year mortgage pays back nearly double what they borrowed. On a $300,000 loan at 6.5%. You're sending the bank over $382,000 in interest before it's done. That's a second house. That's your retirement. Gone. And the advice everyone gets, make your payments on time, maybe throw in a little extra when you can, isn't wrong. It just keeps you legal. It doesn't set you free. What makes it worse is that most people think refinancing is the only exit. So they watch rates for months, wait for a dip, pay $5,000 to $8,000 in closing costs, reset their loan term, and start the amortization clock all over again. Sometimes that's smart. Most of the time, it's expensive shuffling. Because here's what nobody tells you about a standard mortgage. Your first years of payments are almost entirely interest. Year one on a $300,000 loan at 6.5%, you might pay $23,000 in interest and knock out maybe $4,000 of principal. The bank collects its profit first. That's not a conspiracy. That's just how amortization is structured. But math works both ways. And that's where this strategy lives. The move is called principal curtailment. Banks don't advertise it. There's no marketing campaign. But here's the mechanic. Every extra dollar you send to principal doesn't just reduce what you owe. It wipes out every future month of interest that dollar would have generated for the remaining life of the loan. On a $300,000 loan at 6.5% over 30 years, adding just $200 extra per month toward principal from day one cuts your loan to roughly 24 years and saves around $86,000 in interest. $200. That's one car payment, 4 dinners out, and it saves you $86,000. The loan shrinks by 6 full years. But most people never do this because nobody lays out the sequence clearly. So before you touch anything else, make one phone call to your loan servicer and ask 3 things. 1, does your loan allow prepayment without a penalty? Most do, but some older loans carry clauses you need to know about. 2, how do you designate a payment specifically to principal if you just send extra money without specifying? Some servicers apply it to next month's payment instead of your current balance. That's a real difference. 3, can you get your full amortization schedule? Most homeowners have never seen it. Once you do, You can't unsee it. That call is step one. 20 minutes free. Do it before you do anything else. Now, phase two. And this is where the numbers get serious. The bi-weekly payment method. Instead of 12 monthly payments per year, you split your payment in half and pay every 2 weeks. Because there are 52 weeks in a year, you end up making 26 half payments, which equals 13 full payments instead of 12. That bonus payment goes straight to principal automatically every single year. On that same $300,000 loan, switching to bi-weekly payments alone eliminates 4 to 5 years off your term and saves $60,000 to $70,000 in interest. Stack that on top of the $200 monthly principal payment from phase one, and you're looking at eliminating somewhere between $150,000 and $200,000 in total interest. That's the number in the title, not a gimmick, just math applied consistently. Decision framework. If you're carrying high interest debt, credit cards over 15%, personal loans over 10%, pay those down first. The math there beats mortgage paydown every time. If you have zero emergency fund, build 3 months of expenses before you add principal payments. But if your emergency cushion is solid and your high rate debt is clear, there is no better guaranteed return than killing mortgage interest. A 6.5% mortgage paid down early is a 6.5% guaranteed return. No market risk, no volatility. Show me a savings account doing that right now. Where you set this up matters. Let me be specific, because vague advice is exactly how people waste money on the wrong thing. Do not pay a third-party company to manage bi-weekly payments for you. There are services charging $300 to $500 up front, plus monthly fees, to do what you can do yourself for free. All they do is hold your half payment in escrow for 2 weeks and forward the full amount. You are literally paying someone to hold your money. Don't do it. Contact your loan servicer directly. Many, Wells Fargo, Chase, Rocket Mortgage, offer bi-weekly enrollment at no cost. If yours doesn't, here's the manual version. Divide your monthly payment by 12 and add that amount to each monthly payment, designated to principal only. Same result as bi-weekly. No third party, no fees. 3 reasons this works. The return is guaranteed, unlike the market. Your servicer is legally required to apply designated principal payments correctly. You have recourse if they don't. And watching your principal balance drop faster than scheduled keeps people motivated enough to actually stay the course. That last one matters more than people admit. One real number to know. Some servicers have a processing window where additional payments made too close to your due date get pushed to the next cycle. Call and ask about the cutoff. Make your extra principal payment mid-month to avoid the issue entirely. Now the objections, because I know exactly what's coming. I can't afford an extra $200 a month. Pull 3 months of bank statements. Actually look at them. Not estimate, look. Food delivery. Streaming services you forgot about. Random subscriptions. Convenience fees that add up without you noticing. Almost everyone finds $200 when they're forced to look directly at real numbers instead of guessing. And if $200 genuinely isn't possible right now, start with $50. On that same $300,000 loan, $50 extra per month still saves over $25,000 and cuts more than a year off your loan. The amount scales up as your situation changes. Start somewhere. The mortgage interest deduction means I should keep the debt for the tax benefit. This gets repeated constantly, and it's mostly backwards. The deduction only helps you if your total itemized deductions clear the standard deduction. For a married couple in 2024, that's $29,200. Most middle-income homeowners don't get there, so they aren't actually deducting anything. And even if you are itemizing, say you paid $15,000 in mortgage interest and you're in the 22% bracket, your tax savings is $3,300. You still paid $11,700 in interest to get there. That is not a win. You're paying $1 to save 22 cents. What if I invest the extra money and earn more than my mortgage rate? Honest answer. Historically, over long periods, the market has outperformed most mortgage rates. But two things. First, that's average returns across decades that include crashes and years where you lost money. The mortgage paydown is guaranteed every single time. Second, most people asking this question aren't actually investing the difference. They're spending it. If you have real investing discipline and you're already maxing your 401k and IRA, the math might favor investing at sub 4% rates. But at 6.5% and above, the guaranteed return argument gets very hard to beat. Be honest with yourself about which category you're actually in. My loan has a prepayment penalty. Some do. But here's what I want you to actually do. Read your loan documents or call your servicer and ask directly. Don't assume. I've talked to homeowners who were certain they had prepayment penalties and didn't. The penalty is often either expired, many only apply in the first 3 years, or it only covers large lump sum payments, not regular monthly additions. Know what your loan actually says before you opt out of saving 6 figures. Your 4-step action plan starting this week. Step 1. This weekend, find your servicer's phone number and make the call. Ask the 3 questions: prepayment penalty status, how to designate principal payments, and request your amortization schedule. 20 minutes. Free. This step gives you everything you need to execute the rest. Step 2. Go through 60 days of real spending and find your number. Not a guess, actual statements. Find $200 or $100 or $50. Cancel one subscription you haven't used this month. Cut one food delivery order per week. Sell something sitting in your garage. Commit to a number and treat it like a bill. Non-negotiable. Step 3. Automate it this month. If your servicer offers a bi-weekly program, enroll today. If not, set a recurring bank transfer mid-month to your mortgage account, designated to principal. The automation removes the decision. That's the point. Willpower is not a financial strategy. Step 4. Every January, increase the amount by at least $25. Small escalations compound over time. And the moment you pay off any other debt, car loan, credit card, whatever, redirect that full payment amount directly into your mortgage principal. Stack every freed up payment onto this strategy. Now let's be clear about what this covers and what it doesn't. Extra principal payments on your primary mortgage, yes, works exactly as described. Additional payments on a home equity line of credit, yes, same logic, often more urgent since HELOCs usually carry variable rates. Applying extra payments to auto loans, yes, same amortization mechanic, just a shorter timeline. Refinancing into a shorter term, yes, but only when the all-in math works. And you're not resetting from year 8 back to year 1. Run the full numbers, not just the monthly payment difference. Paying extra toward income-driven student loan repayment, no, completely different structure. The logic here doesn't transfer. Extra mortgage payments while you're carrying 20% credit card debt, no, that's backwards. The high-rate debt beats everything else. And trying to run this strategy with no emergency fund, no. one unexpected expense, and you stop the payments and potentially miss a mortgage payment. That costs you more than you saved. Here's your assignment for this week: get your amortization schedule and write down the total interest you'll pay over the life of your loan. Just look at the number, sit with it for a second, then make the phone call. You don't have to overhaul your entire financial life today. You just have to get the real number in front of you, because once you see it, you'll want to change it. If this just showed you how to save $200,000 you didn't know you were losing, the least you can do is send it to one person you know who owns a home. One share, subscribe if you want the stuff. The financial industry definitely doesn't want showing up in your feed. I'm Amelia. Go make something happen.